Welcome to the channel, everyone. Today, we're diving deep into the world of personal finance with 10 crucial money tips that everyone needs to know. Whether you're just starting out or looking to level up your money game, these tips will give you a solid foundation for making smart financial decisions. So, grab a notebook, get comfortable, and let's get started on the path to financial success. Alright, let's kick things off with the foundation of any solid financial plan: budgeting. Budgeting isn't about limiting your fun. It's about understanding where your money is going so you can make it work harder for you. The first step is to track your income and expenses. This means writing down every single dollar that comes in and goes out. You can use a simple spreadsheet, a budgeting app like Mint or YNAB, or even just a good old-fashioned notebook. The key is to be consistent and honest with yourself about your spending habits. Once you have a clear picture of your cash flow, you can start creating your budget. Begin by listing your essential expenses like rent or mortgage payments, utilities, groceries, and transportation costs. Then, factor in your non-essential expenses such as dining out, entertainment, and shopping. The goal is to allocate your income in a way that aligns with your financial goals. Trust me, the peace of mind that comes with knowing where your money is going is priceless. Life is full of surprises, and unfortunately, not all of them are good. That's where an emergency fund comes in. An emergency fund is essentially a financial safety net that can help you cover unexpected expenses without going into debt. Imagine this: your car breaks down, you have an unexpected medical bill, or you suddenly lose your job. These situations can be stressful enough without the added burden of financial worry. So, how much should you save in your emergency fund? A good rule of thumb is to have 3 to 6 months worth of living expenses saved. Start by setting a realistic savings goal and then break it down into smaller, more manageable chunks. Even if you can only afford to save a small amount each month, it's better than nothing. Building an emergency fund takes time and discipline, but it's one of the most important things you can do to protect yourself financially. High-interest debt, like credit card debt, can be a major drain on your finances. Those high interest rates can quickly add up, making it feel like you're constantly playing catch-up. The sooner you can pay off high-interest debt, the better off you'll be. There are two main strategies for paying off high-interest debt: the snowball method and the avalanche method. The snowball method involves focusing on paying off your smallest debts first, while making minimum payments on your other debts. This can give you a sense of momentum and motivation as you see your debts disappear one by one. The avalanche method, on the other hand, involves tackling your debts with the highest interest rates first. This approach can save you more money on interest in the long run. Once you've chosen a strategy, create a debt repayment plan and stick to it as closely as possible. Remember, paying off debt takes time and effort, but the feeling of being debt-free is truly liberating. Chapter 4. Invest early and often. Time is your greatest asset. Investing is one of the most powerful tools you have for building wealth over time. The earlier you start investing, the more time your money has to grow. Even if you can only invest a small amount each month, starting early can make a significant difference in the long run. This is due to the power of compound interest. Compound interest is essentially interest earned on interest. When you reinvest your earnings, your money grows at an exponential rate. To illustrate this, let's say you invest $1,000 today at a 7% annual return. After 10 years, your investment would grow to almost $2,000 without even adding another dollar. By investing consistently over time, you can increase your chances of achieving your financial goals. Chapter 5. Diversify your investments. Don't put all your eggs in one basket. When it comes to investing, diversification is key. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and real estate, as well as within those asset classes. By diversifying your portfolio, you reduce the risk of losing all your money if one particular investment performs poorly. There are various ways to diversify your portfolio. You can invest in different sectors of the economy, different geographic regions, and different investment styles. You can also choose to invest in index funds or mutual funds, which offer instant diversification by investing in a basket of different assets. Diversification is not a guarantee against loss, but it can help to mitigate risk and potentially enhance returns over the long term. It's about finding the right balance between risk and reward for your individual needs. Chapter 6. Live below your means. The golden rule of financial freedom. Living below your means is one of the most important things you can do to achieve financial freedom. It sounds simple, but it can be challenging in today's consumer-driven society. Living below your means doesn't mean depriving yourself of everything you enjoy. It simply means being mindful of your spending and making conscious choices about where you allocate your resources. Start by tracking your spending for a month and identifying areas where you can cut back. The goal of living below your means is to free up more money to pursue your passions, achieve your financial goals, and live a more fulfilling life. Chapter 7. Plan for retirement, don't work forever. Retirement might seem like a lifetime away, but it's never too early to start planning. The earlier you start saving for retirement, the more time your money has to grow, thanks to the power of compound interest. The first step in retirement planning is to determine how much money you'll need to live comfortably in retirement. Once you have a target savings goal, explore different retirement savings plans, such as 401(k)s and IRAs. These accounts offer tax advantages and can help you grow your retirement savings faster. If your employer offers a 401(k) match, contribute at least enough to get the full match. By saving consistently over time, you can set yourself up for a comfortable and enjoyable retirement. Chapter 8. Understand taxes. Keep more of your hard-earned money. By understanding the basics of taxes, you can potentially minimize your tax liability and keep more of your hard-earned money. The first step is to understand the different types of taxes you might owe, such as income tax, property tax, and sales tax. When it comes to income tax, there are various deductions and credits that can lower your tax bill. For example, if you're a homeowner, you can deduct mortgage interest and property taxes on your federal income taxes. If you're self-employed, you can deduct business expenses. It's also important to be aware of tax-advantaged accounts like 401(k)s and IRAs, which allow you to save for retirement on a tax-deferred basis. Consider consulting with a qualified tax professional to ensure you're taking advantage of all available tax breaks and strategies. Knowledge is power when it comes to taxes. Chapter 9. Protect your credit score, your financial reputation. Your credit score is essentially your financial reputation. It's a 3-digit number that lenders use to assess your credit worthiness or how likely you are to repay a loan. A good credit score can open doors to lower interest rates on loans, credit cards, and even insurance premiums. On the other hand, a poor credit score can make it more difficult and expensive to borrow money, rent an apartment, or even get a job. The most important factor is to pay your bills on time, every time. This includes credit card bills, loans, utilities, and even your rent. It's also crucial to keep your credit utilization low. Credit utilization refers to the amount of credit you're using compared to your total available credit. Check your credit report regularly for errors and inaccuracies. By practicing responsible credit management, you can build and maintain a good credit history. Chapter 10. Continuously educate yourself. Knowledge is power. The world of personal finance is constantly evolving, so it's crucial to stay informed and continuously educate yourself. There are countless resources available to help you improve your financial literacy. From books and articles to podcasts and YouTube channels, there's a wealth of information at your fingertips. Take advantage of free online resources such as Investopedia and Khan Academy, which offer comprehensive guides and tutorials on a wide range of financial topics. By investing in your financial education, you're investing in your future. That's a wrap. Thanks for watching. I hope you found these 10 money tips helpful. By implementing these tips and making informed decisions, you can take control of your money and work towards achieving your financial goals. If you enjoyed this video and found it valuable, please give it a thumbs up and subscribe to the channel for more finance tips and advice. And don't forget to hit the notification bell so you don't miss any future uploads. Let me know in the comments below which tip you found most useful or if you have any other money tips to share with the community.